Alright traders, you're welcome back to the second week of the Elite Traders program. And in this week, we're going to go through the 7 institutional reference points in the ICT concepts. We're going to go through every single one of them, and I will explain every single one of them to you in detail. So if you've not watched the videos I've shared with you in the first week, make sure you go back and watch those videos, because this is just a building block to what you've already known. So let me get into it. We have 7 institutional reference points. As you can see, we are supposed to go through them in the week 2 of this course. We're going to start with mitigation block, breaker block, liquidity void, fair value gap, order block, rejection block, old highs and old lows. So in this particular video, I will be explaining what exactly is a mitigation block, one of the very powerful institutional reference points that you need to know. So let me show you what exactly is a mitigation block. Now, remember in the first week, I started by showing you how price delivers liquidity. You want to see price keeps going, all right? As price keeps going up in a bullish movement, we want to see price creating higher highs and higher lows, all right? But in a situation where we have a failure swing, instead of price creating a higher high, we end up having a failure swing that could not make a higher high, failing to make that higher high, and it crashes down into this area, creating a shifting market structure, failing to create a higher high, all right? So a failure swing in this area will now bring in our mitigation block. This is what we call a mitigation block. Now, ideally, this place, the last point where we have the bearish candle printed, because as price is coming down, this is a bearish movement, right? So the last bearish candle that price printed, right? As price prints that last bearish candle before pushing up to the next high, which happened to be a failure swing, we call this last candlestick, which is supposed to be our bullish order block. If we were to break above here and create a high, now it has become our mitigation block. So this point is very important because price will often retrace back and locate that area before crashing. Now we have a bullish mitigation block and a bearish mitigation block. The name comes after the kind of action they create immediately when price reacts from them. So if the mitigation block pushes price downward after touching it, we call it a bearish mitigation block because price quickly runs away from it, all right, to the downside. In a situation where we have price coming down, and when we have price doing this, having a failure swing pushing up, as price comes back, touches this area, which is supposed to be our mitigation block, as I am explaining right here. So this place, the last bullish candle in this case, not the last bearish candle, the last bullish candle, this is the difference, becomes your bullish mitigation block. So if price comes back to retest this area and push up, you have this particular mitigation block as your bullish mitigation block. Don't forget, please, every time price touches a mitigation block and it moves up, it becomes a bullish mitigation block. And if it touches it and moves downward, it becomes a bearish mitigation block. So in a bullish trend, when we have price retracing and it printed the last bearish candle before having the failure swing, don't forget that failure swing because it is important in the subsequent lesson. The failure swing is what differentiates this mitigation block and a breaker block, all right? So when you have this push failing to take out this guy, you have a mitigation block. Look at this one, failing to take out this guy to the downside, you have a mitigation block. So let me show you an example right here. I have a sketch right here where I showed you a mitigation block. Look at this. As price was coming up to this level, right to this area, we have price retracing into this place. We want to see price take out this high, because that is how an uptrend forms. If we successfully take out this high, we have created a new range. But then price failed to take that out and it crashes down, all right? Now we have a failure swing, all right? I hope this is understandable enough. As price pushed, it failed to take out this high. Look at this. This guy was here. the highest level was there and then it crashes down, then which one becomes your mitigation block is the next question you will ask. Which one is now your mitigation block? Remember I said the last sell candle, which is this guy. You can see I've already marked that area. The last sell candle before price start going up is your mitigation block, and in this case is what? It's a bearish mitigation block. It's a bearish mitigation block. Look at what happened as price came back up to this area. Notice how price touched this mitigation block right at this point and it crashes down from there. So that is an entry. That is how a mitigation block works perfectly. All right, perfectly. So every time you see a mitigation block, you will see a failure swing and then it crashes down. That is a bearish mitigation block because price moved downward immediately after that one. All right, let me see if I can see another example for you. Yes, this is another mitigation block. Look at this one. Price coming. Look at this. Price moved up to that area, creating this low, failure swing, and it crashes down. All right, so what do you call that one? That is your mitigation block. The same bearish mitigation block, because what happened after that one, this place decided to push price downward, and that is your mitigation block. Look at this. As price was coming back, it tested that area and it then moved down straightway. So please don't struggle with identifying a mitigation block. This is a bearish mitigation block. The last sell candle becomes your bearish mitigation block. Let me see if I can see a bullish mitigation block and give you an example with a bullish mitigation block. All right, right here I can see a bullish mitigation block. Look at this. Price coming, all right, pushing up. Did you see a failure swing here? Price moving up to that area. So the failure swing becomes your edge. Look at this. Is this lower than this? Yes. So in this regard, we will map out our last buy candle, our last bullish candle, as our bullish mitigation block. Don't forget, look at how price came back to touch it. Price actually came back to touch this area and boom, it went up from that area. So what do we call this again? A bullish mitigation block, because we have a failure swing. This is lower than this. If you take this line like that, this is the only difference between a mitigation block and a breaker block. All right, guys, in the next video, I will show you a breaker block, but then you can also get more understanding in the training ground where you're going to go through an example. You're going to make your guesses and then I will show you whether you're correct or wrong. Thank you guys for watching. See you in the next video.